Ever wonder what makes a massive gaming company tick? Beyond the flashy trailers and the epic gameplay.
Right, because there's a whole complex business machine running underneath.
Exactly. And today we're doing a deep dive into the business of Electronic Arts, better known as EA. We're looking at their recent 2025 annual report.
Yeah, this is the official stuff. It's their Form 10-K filed with the SEC back on May 13th, 2025, covering their fiscal year that ended March 31st.
And our mission today is really to unpack the key financial insights, the strategic plays, and maybe some of those hidden risks you might not see otherwise.
We're aiming to pull out those vital nuggets of knowledge, essentially giving you a shortcut to truly understand one of the biggest players in interactive entertainment.
We think we'll uncover some surprising facts about how a gaming giant like EA actually generates its revenue, where its focus really lies now, and the intricate challenges it navigates. Okay, let's unpack this.
Sounds good.
So, starting high level, when we talk about Electronic Arts today, what's their core identity? Are they still just making games?
Well, they're definitely making games, but it's much bigger than that. EA is a global leader in digital interactive entertainment. They develop, market, publish, and deliver games, content, and services pretty much everywhere. Consoles, PCs, mobile devices.
And across all sorts of genres, right?
Yeah.
Sports, racing.
Yeah, first-person shooters, action, RPGs, simulation. It's a really diverse portfolio. And their core strategy, it's not just shipping a disc anymore. It's about building these global online communities around their big franchises.
The community aspect.
Exactly. Deepening engagement, connecting storytelling to their IP, and then using those communities to grow in, around, and even beyond the games themselves.
Okay, and here's where I think it gets really interesting for their business model. Live services. This isn't just about selling new games anymore, is it?
Not at all. This is the powerhouse. Live services are designed to provide ongoing value, keep players playing, extending and enhancing the game long after launch.
So we're talking extra content, subscriptions, that kind of thing.
Precisely. And the numbers are, frankly, staggering. In fiscal year 2025, live services and other net revenue hit $5,461 million.
Wow. Okay, what percentage is that of their total?
That's a massive 73% of their total net revenue.
73%. So most of their money isn't from selling the base game.
Correct. It fundamentally shows how EA's model has shifted to continuous engagement. Think ongoing revenue streams. And the most popular, the most material part of this is the extra content in the Ultimate Team modes for their sports games.
Like in FIFA or FC Now and Madden?
Exactly. Global Football FC Ultimate Team and American Football Madden NFL Ultimate Team. Players collect stars, build teams, compete.
And spend money.
And spend money, yes.
Yeah.
That revenue is absolutely material to EA's business.
So they make all this content. How does it get to us, the players? Consoles are still huge gatekeepers, I imagine.
Oh, absolutely. Console dominance is still a major factor. EA mainly distributes through partners like Sony and Microsoft. Just look at FY25. Direct sales to Sony were about 39% of total net revenue.
39% just from Sony.
Yeah. And Microsoft was about 17%. So together, that's well over half their revenue flowing through those two console platforms.
That level of dependence, it sounds potentially risky. What does that mean for EA day to day?
It means the console manufacturers hold a lot of the cards. They unilaterally decide a lot of key commercial terms, like manufacturing terms, delivery times, store policies, approval conditions, and these can change.
So Sony or Microsoft could just change the rules.
They can. They can also require EA to indemnify them for claims. And importantly, they're not obligated to give EA licenses for future consoles.
That's a powerful dynamic. It puts EA in a somewhat dependent position.
It certainly does. It's a key relationship they have to manage very carefully.
But it's not just consoles. How about PC and mobile?
Right. On mobile, they distribute apps and content via Apple and Google storefronts, those big third-party platforms. On PC, you can get games directly through their own EA app, their digital storefront, or through others like Steam.
Steam's still a big player there.
Definitely. And they also have specific deals, like with Tencent, Nexon, and Garena, to publish certain free-to-play games, mobile and PC, in specific regions, especially in Asia.
Which ties into their flexible business models, right? It's not just one way to pay.
Exactly. You've got the traditional buy-the-game purchase, you've got subscriptions like EA Play and EA Play Pro, and then the big one, free-to-play, where the game is free up front, but revenue comes from those ongoing live services we talked about.
And a franchise like EA Sports FC, uses all of these.
It's a prime example. You can buy the game, subscribe, play modes that have heavy live service elements across different platforms. It's multifaceted.
And underlying a lot of this is the big digital transformation. People are buying downloads, not discs.
Absolutely. The trend is undeniable and accelerating. Just looking at unit sales on Xbox and PlayStation. In fiscal 2025, an estimated 78% of EA's units sold were digital.
78%, up from what, the year before?
Up from 73% in FY24 and 68% in FY23. It's a clear, steady climb.
And what does that mean for the bottom line? More digital must be good for profits, right?
Generally, yes. It usually leads to an expansion of their gross margin. Selling digitally has lower costs, no manufacturing discs, shipping, less retail cut.
So fewer middlemen, more profit per sale.
Essentially, yes. More digital sales often translate pretty directly to higher profitability.
But it's still concentrated, isn't it? A lot of this relies on just a few big names.
That's a crucial point. A significant chunk of EA's revenue comes from products and services tied to just a few very popular franchises. We're talking EA Sports FC, the American football games, college football, Madden NFL, then Apex Legends, and The Sims. These are the pillars.
Okay, those are the strategies, the business model shifts. Let's get into the numbers game now. How did EA actually perform in fiscal year 2025 ending March 31st?
All right, the headline figures. Total net revenue was $7,463 million. That was actually down 1% year over year.
Down slightly. Okay, what about live services?
Live services and other net revenue also dipped slightly, down 2% to $5,461 million. Still the huge majority, but a small decrease.
But you mentioned margins earlier.
Right. Here's the flip side. Gross margin was up 2 percentage points year over year, hitting 79.3%.
Interesting. So revenue slightly down, but they're keeping more of each dollar earned. Efficiency gains.
That's likely a big part of it, yeah. That digital shift we discussed probably helped there. Operating income was basically flat year over year at $1,520 million. Net income came in at $11,121 million.
And per share.
Diluted earnings per share were $4.25. One figure that was down more significantly was net cash from operating activities, $2,079 million, down 10% year over year.
Okay, and how much cash did they end the year with?
They had a solid position, $2,248 million in total cash equivalents, and short-term investments.
So diving into that small revenue dip, that $99 million decrease from FY24, what was the main driver there?
It was mainly driven by a pretty big decrease, about $789 million, linked primarily to lower sales of extra content for Apex Legends.
Ugh. Apex softening a bit, maybe.
And also comparing against the prior year, which had the big release of Star Wars Jedi Survivor, that game wasn't new in FY25.
Right, tough comparison. But it wasn't all negative.
No, that decrease was significantly offset by a $690 million increase in net revenue, mostly coming from their American football games.
College football's return must have helped there.
Absolutely. EA Sports College Football 25 was a big driver of that increase.
Now, you mentioned another metric companies like EA use, net bookings. Remind us why that's important for investors watching this space.
Right. So revenue recognition, especially for live services, can be spread out over time. Net bookings gives you a more immediate snapshot of sales performance in the period. It's the net amount of products and services sold digitally or physically shipped in that specific time frame. It's a key indicator of current momentum.
And how did net bookings look for FY25?
Net bookings were $7,355 million for the year. That was also down slightly, a 1% decrease compared to FY24.
Okay, and the why behind that dip? Similar reasons to the revenue.
Pretty similar, yeah. The decrease was mainly due to, again, the comparison with Star Wars Jedi, Survivor launching in the prior year. Also, that year-over-year decrease in extra content sales for Apex Legends played a role.
Right.
And also a decrease in sales related to the global football franchise. So, legacy FIFA titles and some reported softness in the full game sales for EA Sports FC 25.
But again, offsets.
Yes. Partially offset by the stronger sales from American football, driven by College Football 25, and they also had new releases like Split Fiction and Dragon Age, the Veilguard contributing.
How did it break down between live services and full games for bookings?
Live services and other net bookings were down 2%. That was mainly the Apex Legends and the Global Football Ultimate Team extra content factors. Full game net bookings, interestingly, actually increased slightly, less than 1%, driven by American football and the new releases, which managed to offset that Star Wars prior year impact.
Got it. Okay, so that's the money coming in. What about the money going up? The cost of doing business. Cost of revenue first.
Cost of revenue actually decreased by $167 million in FY25. That's a 10% decrease,
Why the drop?
primarily due to lower product-related costs and royalties for the EA Sports FC franchise, maybe linked to the slight sales softness or renegotiated terms post-FIFA branding. Also, lower platform and online hosting fees and less amortization expense from past acquisitions' intangible assets.
Okay. And what about investments in the future? R&D spending. You mentioned AI earlier.
Yeah, research and development spending definitely went up, increased by $149 million, that's 6%, hitting $2,569 million in FY25.
So still investing heavily in development.
Clearly, it reflects ongoing investment in their studios. The report points to higher personnel costs, more stock-based compensation, and more spending on contracted services. And crucially, they specifically call out investing in R&D to incorporate artificial intelligence into their products and services.
They expect AI to speed things up.
Yeah, accelerate production and enable totally new player experiences. It's a stated focus area for continued investment.
What about getting the word out? Marketing and sales costs.
Marketing and sales actually decreased by $57 million, or 6%, down to $962 million.
Why was that down? Fewer big launches?
Primarily, yeah. Less ad spend needed compared to the prior year, which had Star Wars Jedi, Survivor, and Apex Legends pushes. That was partly offset by increased spending for the launch of Dragon Age, the Veilguard in FY25.
And the general overhead, G&A?
General and administrative costs increased by $54 million, or 8%, reaching $745 million, mostly due to higher personnel costs against stock comp and increased IT and facility costs.
Okay, let's talk taxes. That effective tax rate jump was significant, 19.9% in FY24, up to 30.2% in FY25. What was the main story there?
The big item was a $51 million tax charge. It was to increase something called the valuation allowance on their Swiss deferred tax assets.
Okay, translating that.
Basically, it means they're less sure they'll be able to use certain tax benefits they have banked in Switzerland in the future. So they have to account for that uncertainty now. It's driven by various things, how their business is doing there, the mix of income globally, and interestingly, a rise in Swiss interest rates impacting the calculation.
But they still have cash overseas.
Oh, yeah. What's fascinating is about $1.1 billion of their cash was held overseas in foreign tax jurisdictions. And critically, they state all of it is available for repatriation, bringing it back to the U.S. without a material tax cost. That's significant financial flexibility.
Speaking of financial flexibility, what does all this tell us about their overall financial strength and how they treat shareholders?
Well, they ended the year with that solid $2.2 billion in cash and short-term investments, and they returned a lot to shareholders in FY25, $2,699 million, nearly $2.7 billion.
How did they do that? Buyback.
Mostly buybacks, yes. They repurchased 17.6 million shares for about $2.5 billion. Plus, they paid out $199 million through their quarterly dividend program, which was $0.19 per share each quarter.
And they're continuing the buybacks.
Seems so. They authorized a new, massive $5.0 billion share repurchase program in May 2024, running until May 2027. And they're actively using it. They even entered into a $1.0 billion accelerated share repurchase agreement, an ASR, back in February 2025.
What about debt? Were they carrying much?
They have about $1.9 billion in senior notes outstanding. These mature over a long period, 2026, 2031, and way out in 2051. They also have a $500 million revolving credit facility, like a corporate credit card, established in 2023. As of the end of FY25, it was completely undrawn, so available if needed.
So looking ahead, do they feel comfortable about meeting their financial needs?
They state they believe their current cash, future cash from operations, and that credit facility will be sufficient. Sufficient to meet all their material cash needs for the next 12 months and beyond.
Which includes things like
big licensing payments to sports leagues and player associations, paying back that $1.9 billion in debt eventually, funding operations, capital expenditures. They expect about $225 million in CapEx in FY26 for hardware, software, real estate, and potentially funding future acquisitions or strategic investments, too.
Okay, so financially they seem positioned. Let's pivot now to the minefield, the key risks and how they're trying to respond. Competition has to be top of the list, right?
Absolutely. The interactive entertainment market is intensely competitive and changes incredibly fast. EA faces significant competition from other big established players, nimble startups, and even huge diversified companies like Microsoft, Sony, Tencent, Apple, Google, who have deeper pockets.
And that reliance on just a few big franchises makes them vulnerable here.
Definitely. They acknowledge that the underperformance of just one major title has hit them before and could again have a material adverse impact on their results. It raises the stakes on every big launch.
And the pace of innovation itself is a risk. Technologies, business models, how games are distributed, it all changes so fast.
It's a constant challenge. They have to anticipate these shifts and invest years in advance. A key risk they highlight is failing to anticipate or successfully adopt new tech.
Like AI.
Exactly. Especially with AI advancing so rapidly, competitors might integrate AI tools better or faster. Plus, they note the use of AI brings potential social and ethical issues. If not managed right, that could lead to legal trouble or damage their reputation.
Speaking of reputation, meeting player expectations is a constant battleground too, isn't it?
Huge. Players and other stakeholders have incredibly high expectations for game quality, fairness, the business models used.
We certainly hear criticism sometimes.
Right. EA acknowledges facing criticism on gameplay, fairness, monetization. Negative reviews hurt visibility on digital storefronts. And user-generated content inside games is another tricky area. Potentially objectionable stuff could expose them to lawsuits or regulatory issues and hurt their brands.
And bugs, games are complex.
Very complex. Despite quality control, defects or bugs can happen. That could mean refunds, pulling a game from sale, or pouring resources into fixes. It's a constant quality challenge.
We touched on platform reliance earlier. Let's revisit that as a risk, relying so heavily on Sony, Microsoft, Apple, Google.
It's a significant risk factor. These partners control access, distribution, and they can unilaterally change policies, fee structures.
So Apple could just increase its App Store cut, for instance.
Potentially, yes, or change developer rules. And if these major platforms stumble, fail to keep up with what consumers want, or have major outages that directly hurts EA's business.
What about relying on external developers sometimes?
That adds another layer of risk. When they contract out development, they have less direct control over schedules. If those external studios fail to deliver, it means delays, cancellations, or higher costs for EA.
Okay, one area where their report seemed quite detailed was cybersecurity. Feels like a top priority.
It absolutely comes across that way. They stress how critical the integrity of their IT networks is. They have a whole structure, policies, practices, programs to assess and manage cyber risks, led by their Chief Information Security Officer, the CISO.
What kind of measures are they taking?
Things like investing in tools to spot suspicious account activity, offering players two-factor authentication, trying to prevent mass fake account creation. They do regular penetration testing, vulnerability testing to check their defenses. They have controls for third-party vendors who handle confidential data.
And training?
Mandatory annual security training for all employees and certain contractors.
And who oversees this at the highest level?
The board of directors has ultimate oversight, getting updates at least once a year from the CSO. And their audit committee, which is all independent directors, gets updates quarterly or more often if needed. It's a very structured oversight process.
And did they report any major breaches in FY25?
Despite acknowledging ongoing risks, they stated they did not experience any cybersecurity incident that had, or was reasonably likely to have, a material impact on their operations or financials during the period.
That's good news. What about the regulatory landscape? That must be complex for a global company.
Hugely complex and constantly evolving. They're subject to laws across the globe covering gaming itself, privacy, data collection, consumer protection, online safety, content, advertising, IP, taxes.
And things like loot boxes or virtual currencies.
Those business models using virtual items and currency face increasing scrutiny. New laws or different interpretations of old ones could limit sales or just ramp up compliance costs. And that user-generated content issue also brings potential liability and regulatory oversight.
One last risk area, talent. Finding and keeping the right people.
Critical in a creative industry. Their success hinges on attracting, training, motivating, and retaining top executives, technical wizards, creative geniuses, marketing pros, and the market for that talent is fiercely competitive. EA is a target for recruiters. Losing key people could hurt their reputation, brand culture, and delay games.
Okay, we've covered the business, the financials, the risks. Let's bring it back to the investor's perspective. How has EA stock actually performed amidst all this?
Well, the 10K includes the 5-year cumulative total return graph from March 31st, 2020 to March 31st, 2025. An initial $100 investment in EA stock grew to $148.
Okay, so a 48% return over 5 years. How does that stack up?
That's the key comparison. Over that same 5-year period, $100 in the S&P 500 index grew to $235.
Wow, significantly more.
Yeah, the Nasdaq Composite hit $233, and the RDG Technology Composite Index reached $221.
So EA has substantially underperformed the broader market in key tech indices over that 5-year stretch.
It did, which certainly raises questions for investors about its growth trajectory compared to the rest of the tech sector or the market overall during that period.
And the stock price itself can be jumpy, right?
Historically, yes, and they expect that volatility to continue. The market price is very sensitive to whether they can forecast accurately and meet those projections and analyst expectations. Misses can be punished hard.
It also seems they're actively trying to adapt. You mentioned a restructuring plan.
Right, that 2024 restructuring plan. It was focused on realigning their portfolio, their investments, their resources. The report says those actions were pretty much completed by March 31st, 2025. It cost them about $123 million in net charges.
So they're making changes, trying to position themselves better, even if it involves costs.
It shows a company actively responding to the market, trimming, focusing, trying to get leaner or more aligned with where they see future growth.
We've covered a lot of ground here. We've navigated through EA's business, the surprising dominance of live services now, the digital shift.
The reliance on key partners and franchises, the intense competition, the tech shifts like AI.
Right, the regulatory hurdles, their approach to cybersecurity, and how all that filters down into the financials and ultimately stock performance.
Yeah, it's a complex picture. What really stands out to you after going through all this?
For me, it's probably that 73% live services number, just how fundamentally the core business has shifted from selling a game to running a service. That and the sheer power those console platforms still wield.
Definitely agree on both points. It really highlights that gaming isn't just about, fun and games. It's incredibly sophisticated business models, constant adaptation needed in a really dynamic global market.
Absolutely. Okay, so as a final provocative thought for your listener to mull over, considering EA's clear investment in integrating AI into their games and development and all the talk swirling globally about potential AI regulation, how might that intersection cutting-edge AI innovation meeting new legal frameworks? How might that fundamentally reshape interactive entertainment and its business models in the years ahead? Something to think about.